The good opening for the market. The first tick is about 80 points higher.
18,150 on the Nifty.
We continue to be in the green. Good gains. The Nifty has come off from the highs.
So it's a strong day, absolutely no doubt about it. We've got the Nifty, which is not at the high point of the day, but it's been strong from the word go.
The story of the day is that we are up, not really all guns blazing, but we managed to retain most of the gains and no sort of last-minute hiccups.
Right, it was a day where the Nifty held on to that 18,100 mark after dropping below it in the previous trading session. Global environment did well for it, and we did see good gains come by from the Nifty Bank, up almost 0.75%. This is Markets Today on CNBC-TV18. This is a show where we track 6 hours of day's trading action in 5 headlines. So let's talk about those headlines itself. Indian indices start the week on a steady note, regaining losses of the last 2 trading sessions. Positive cues coming in from Asia, and Friday's indications that the Fed may look at less aggressive rate hikes bolster sentiment. Sensex as well as the Nifty, both of them end about 0.5% higher, whereas IT and the Nifty Bank stocks lead the pack. Biggie's ICICI Bank and Kotak Mahindra Bank report record high incomes and margins, while Canara Bank was up in trade as its return on equity rises about 20% on the back of high net interest margins and low credit costs. Mid-cap banks like IDFC Bank and we had RBL Bank also post strong numbers, while Bandhan Bank claims that the worst on stress is behind. Sticking to banks itself, Yes Bank was one of those stocks that slumped 8% after the Bombay High Court quashed the lender's decision to write down its additional Tier 1 bonds worth 8,000 crore rupees to zero. The management tells CNBC-TV18 that the bank will approach the Supreme Court to challenge this decision. Outperformance by the O2C oil to chemicals business helps Reliance Industries beat street estimates for the third quarter. Analysts see healthy refining margins and the exploration business driving the company's growth in 2023. Cement stocks were in focus, as were the metal stocks. UltraTech skidded 4% despite good volume growth as realizations failed to perk up, while steep valuations weigh JSW Steel lower despite decent earnings. Let's tell you what we have for you on the show today. It's a packed one. In Market Opinion, we have Pratik Gupta, who's the CEO and co-head of Kotak Institutional Equities, and in Big Corporate Voices, we have Seshagiri Rao, who's the joint MD and Group CFO of JSW Steel, and some big names from the banking space also coming your way. Let's start with the day's market action. Then the Wall Street regained some of the losses of the last 2 trading sessions. The Nifty and the Sensex ending about 0.5% higher in the green. The IT stocks were the ones that led from the front. In fact, this year itself, the IT has been a stealth outperformer. The Nifty Bank also, which was underperforming until now, outperformed in today's trading session, with that index gaining almost 0.75%. The mid-cap rose in line with the frontline indices. Let's go across to Prashant Nair now, who joins in with all the detailed market action.
Well, it was a good session by all accounts, but I think bulls would have liked a little bit more, a little bit of a push higher. I'll explain in terms of levels in a bit from now. Banks did well. And of course, they followed through from what we had on Friday. The index was up on Friday, and today was no different. There was, of course, a tailwind of ICICI and Kotak numbers as well. Gainers coming through in sectors like IT. I mean, the IT index was up 2% at one point, closed higher by 1.7. Pharma and FMCG were 2 other areas which did well. Lever on the Nifty did quite well. There was Sun Pharma, Aisha. Amongst tech, you had names like Tech Mahindra, TCS and Infosys, which stood out with gains as well. Cement as a pack sold out pretty heavily. UltraTech reported, and I think others took note. UltraTech was the top loser on the Nifty. Grasim was down, but names like Shree, Dalmia, India Cements, JK, they were down and out as well. Gainers coming through in the mid-cap IT space, and they picked up pace after 3 p.m. Coforge was up strongly. Persistent, which it reported, was up strongly. Tata Elxsi was something which stood out. Delivery from the new age companies, bit of a relief there. Shakti Pumps, Canfin Homes and Torrent Power were some of the others. The Nifty needs to add a little bit more to surpass some of the technical levels, maybe another 100 points or so, and it will add comfort to the bulls to take long positions. And of course, from a global perspective, Friday, Wall Street saw a powerful rally, and I think a follow-through later today will only add confidence that perhaps there is more to go here as we head into the final few days before the budget. Back to you.
All right, we take that point, Prashant. Thanks a lot for that. In fact, let's get in some expert opinion on the market as well. Pratik Gupta, who's the CEO and co-head of Kotak Institutional Equities, says that the global slowdown may put further pressure on export-oriented segments, with persistent weakness in the consumer discretionary segment for the coming quarters. But apart from that, he said that India does look resilient, notwithstanding the valuations.
We're probably already at the low end of consensus. Our expectation for the Nifty earnings for FY23 are at 11%. And for FY24 and 25, we're at about 15% CAGR for the next 2 years. And we think there's probably greater downside to the earnings estimates as we go into the March quarter and the June quarters, as the global slowdown intensifies. That in turn, we think will put even more pressure on the earnings estimates for the export-oriented sectors and the consumer discretionary segment. Likewise, we think for the December quarter, we've seen a weak set of numbers coming out so far. And even going into the March and June quarters, we think this weakness will persist. We don't see a trigger for a sharp turnaround in the short term. In general, we think the large cap IT vendors are better placed this time around when you are seeing the end markets, US and Europe, going through a bit of a slowdown. And the mid cap IT companies are generally more vulnerable during times of discretionary spending coming down or vendor consolidation going on. So we prefer as a business the large cap IT stocks, companies which are focused more on BFSI. There, we think the IT spending is going to be more resilient. We have major technology upgrade programs going on, the cloud migration, the new apps being built for the cloud, etc. So there's a lot of work going on over there. So it's going to be less cyclical for the BFSI-focused businesses.
Let's talk about the second headline now. Banks, they were in focus today. The biggies, ICICI Bank and Kotak Mahindra Bank, reported numbers on Saturday. So the stocks were reacting to their numbers today, both of them higher in today's trading session. In fact, we also had Canara Bank reporting numbers today, and that stock was up too. Both ICICI and Kotak Mahindra Bank recorded high net interest margins, whereas Canara Bank was higher as the return on equity for the company rose above 20% on the back of their high interest margins as well and low credit costs. Abhishek Kothari joins in with a wrap on the third quarter performance of all these big bank stocks. Abhishek.
Well, the net interest margin for all the lenders have been robust. So that is aiding in terms of the P&L momentum in Q3 FY23. For ICICI Bank, the net interest margin was at all-time high at 4.65%. And they continue to, outperform SDFC Bank on various parameters. Asset quality, both the gross NPA and net NPA ratio are one of the best in last 8 years or 32 quarters. In terms of P&L, they have beaten our estimate both on NII and PAT. Kotak Mahindra Bank, the net interest margin is one of the highest that you are seeing since Q2 FY15. So it has come in at 5.47%. Deposit growth quarter on quarter at about 6% level. That has actually gone down well with the street. Robust ROA or return on asset, which is close to 2.5%. Both in terms of NII and PAT, it's a beat on our poll. Bandhan Bank, the asset quality surprised positively given the fact that it has remained stable or improved. So gross NPA ratio has improved, net NPA ratio has remained stable. Brokerages are now upbeat given the fact that they say 90% of the stress has come in from the known stress portfolio of the bank. Collection efficiency is back to pre-COVID levels. The SMA book and the unprovided stress are actually down on a sequential basis, and valuations are attractive, and the stock can re-rate if at all they move towards the ROE of 20% level. So across brokerages, they have a buy or overweight rating, target price ranging from 320 to 350. Canara Bank, the gross NPA ratio is the lowest in last 7 years or 28 quarters. Net NPA ratio is the lowest in last 30 quarters or more than 7.5 years. Return ratio is one of the best return ratios that you are seeing for Canara Bank in last 8 years, given the fact that ROE has now crossed the 20% mark for the quarter. Annualized credit cost at a mere 0.9% is the lowest in last 30 quarters, and annualized slippage ratio coming in at 1.5% is the lowest in last 8 quarters. So in terms of P&L, both the NII and PAT is a beat on our poll. Back to you.
All right, Abhishek, thanks a lot for that. All right, in the meanwhile, we also caught up with Chandrasekhar Ghosh, who's the MD and CEO of Bandhan Bank, to talk about their third quarter performance.
If you see that the 14% growth has come to this, up to the third quarter, and fourth quarter, it will come to the 20% and above. No, if you see that the loan growth, we are predicted on that at 2025, and that the CAGR 22 to 25% growth will come. The next quarter onwards, I have not anything is a reverse for NPA interest. So that will be helped me to come to this, the normal 7.5%. And 1% is normally seen that the maximum is 2% my credit cost. It can be go to the 2.5% maximum on that. So in that sense, I have been confidence on that the ROE will be like to make on that the 20 to 22%.
All right, and that's not all. Axis Bank also reported its third quarter numbers today post trading hours with the profit beating expectations, rising 62% year on year. Net interest income too came in above estimates, rising more than 32%. Ritu Singh joins in with the key highlights of those numbers. Ritu, did they look good?
Well, overall, it was a beat on the numbers, a comfortable beat on what the street was expecting, both on the top line and on the bottom line. The profits, they were up by more than 62%. They were aided by a good growth in the loan book, an expansion in the margins as well. The net interest income, the core income of the bank, which is the difference between the fees it earns while giving a loan and while, from the interest that it gives on deposits, that was also up by almost 32%. So good on both of those fronts. Margins expanded sequentially as well to 4.26% in the quarter, and advances growth of 15% was led by retail and SME, as we've been seeing. This trend of advances growth and asset quality improving is something that we've been seeing for most of the banks reporting their third quarter earnings, and Axis Bank was no exception either. Slippages rose slightly in the quarter though for Axis Bank at about 3,800 crores compared to 3,300 in the previous quarter. Of course, the management will be speaking to the media later this evening, so we will be finding out the reason for some of the rise in this elevated level of slippages that we're seeing. The provision coverage ratio also quite good at about 81%. Besides the numbers, of course, any guidance on asset quality, on loan growth, and more importantly on the Axis Bank Max deal, that is also something that we'll be watching out for in the management commentary.
All right, Ritu, thanks a lot for that. In fact, stay with us because the third headline today has been what's taken place with Yes Bank. It slumped about 8% after the Bombay High Court quashed their decision to write down the additional Tier 1 bonds worth almost 1,000 crores, $1 billion, to zero. Additionally, the bank's weak third quarter performance also weighed on the stock. The bank has said that they will appeal to the Supreme Court. So let's see where this goes. But Ritu, what do you have on Yes Bank?
Well, Mangalam, firstly, the numbers weren't great. Profits were down because provisions were elevated. But the bigger worry on the street has been this whole issue of the AT1 or the additional Tier 1 bonds ruling that has come in from the Bombay High Court. A quick primer, during the reconstruction scheme of 2020, the RBI had said that the AT1 bonds, this has been the norm, would be written down because of the high risk involved in that matter. But in the final scheme, it was not mentioned. And therefore, that is what the Bombay High Court has picked on, saying the administrator did not have the right to write off these AT1 bonds, and has now, of course, ruled against that. Now, which led to concerns about what kind of impact that may have on the bank, because there were over 8,400 crores of AT1 bonds it had written off as part of that reconstruction scheme. But, the management has made it very clear. Firstly, the Tier 1 capital will not get impacted, even in the case of an adverse ruling, which, of course, the bank and RBI will appeal in the Supreme Court, because the Tier 1 ratio will only change where the CET1 will come down and AT1 will go up. Secondly, on the interest of paying, on the issue of paying interest on these bondholders, they are perpetual bonds, and therefore it is up to the bank's discretion to pay or not pay the interest, which it is unlikely to do. Now, more importantly, there have been reports that there is a possibility of these AT1 bondholders, converting their bonds into equity, which the bank has clarified to us, sources within Yes Bank, that is not applicable under laws. It is not something that is a possibility. It was suggested as comments to the draft reconstruction scheme, but it did not find favor with the RBI or with the bank, so very low chance of that also taking place.
All right, Ritu, thanks a lot for that. With that, we will hear what the Yes Bank management had to say to CNBC-TV18.
So it is confirmed that we would make an appeal in Supreme Court, okay? And we have been given 6 weeks. Until that time, there is a stay on the order, okay? So that is one part. But we'll make an appeal, and we have the legal opinions which are having very strong grounds for making appeal in the Honorable Supreme Court.
All right, let's take a break now. On the other side, we'll be back with all the other headlines that we are tracking. Welcome back. You're watching us here on Markets Today, the show where we talk about the 6 hours of trade in 5 headlines. We've spoken about 3. Let's talk about the 4th one. Reliance Industries. That was another stock in focus today. It beat street estimates on the third quarter performance, helped by an outperformance coming in from its oil to chemicals business. Analysts saw a healthy refining margin coming in for the company. The exploration business driving growth in 2023 itself. The stock, however, ended at the low point of trade. Sonia Shenoy joins in with more. Sonia.
Well, thanks a lot for that. Reliance Industries was a bit under pressure despite the numbers being better than what the street was estimating. Now, there were a lot of positives in the numbers. In fact, the oil to chemicals business surprised positively, where the EBITDA went up 16%, and it was a strong improvement in margins on the oil to chemicals business to about 10%. Now, Reliance is undergoing a big capacity expansion plan where their capex went up by 16% sequentially at 37,600 crores. What Reliance is doing is, increasing their capex to drive the 5G rollout plan, as well as retail, which is seeing a very aggressive expansion, their retail business, where they're adding 6 million square feet, over 789 new stores. Now, a lot of brokerages are very bullish on the stock. JM Financial reiterated a buy with a target price of 29.50. They expect a robust 14 to 16% EPS compounded growth over the next 3 to 5 years. Nomura, Jefferies and JP Morgan have buys or overweights with target prices of anywhere between 28.50 to 31.10. But here's the niggling worry. Now, the debt of the company has gone up. The net debt has increased 18% quarter on quarter because of the capex towards the 5G rollout as well as the ramp up of the retail business. There's additionally no clarity on tariff hikes in the telecom business. Hence, a couple of these brokerages, despite remaining positive on the stock, have cut down their EPS estimates. Nomura has cut its FY23 EPS by 6%, while CLSA has cut the FY25 EPS by 8%. Back to you.
Sonia, thanks a lot for that. Let's talk about the fifth headline for the day then. UltraTech skid about 5%, and this despite decent volume growth in the third quarter. The street was worried about realizations. That failed to perk up in the third quarter, in fact. And in this quarter itself so far, we haven't seen price hikes come by for cement. The management also flagged rising input costs, saying that the overall cost trend for the sector is likely to stay elevated, as a result of which Shree Cement too was lower in today's trading session, along with all the other cement stocks. Nigel D'Souza joins in with the details. Nigel.
Well, that's right. UltraTech Cement's numbers are more or less in line, but the lower realizations, or the increase of just around 0.5% in comparison to around 2% that the street was working with on a sequential basis, seems to have spooked the street. And that's why it's not just UltraTech, the other stocks as well reacted negatively. Let's run you through the management commentary. Now, the street was hoping maybe there'll be some kind of clarity on the cement pricing itself, because first look at the numbers, well, it appeared that the realizations were a miss. But the management says that cement prices are likely to be stable. There's no concrete guidance in terms of price increases, and the street, well, they would be working with higher price increases for the fourth quarter as well as for FY24, which appears to be a little bit on the back burner. And profitability will be driven now by operating leverage. That's capacity utilization levels are likely to move up, as well as savings in terms of raw material cost as well. They did say though that demand is rock solid, and ahead of the election year, well, you're expecting demand to see a good pickup as well. So utilization levels for the past quarter were around 83%. They're expecting it to go up in quarter four. The blended cost, of fuel in the past quarter was around $200 per ton. It didn't reduce on a sequential basis, but in the coming quarter, well, it could reduce by around $20-25 per ton, which will translate to roughly around 150 rupees on a per ton basis. The overall cost trend, though, is likely to stay up because of the ongoing conflict between Russia as well as Ukraine. Point number one, China reopening, and no additional petcoke capacity coming on stream. Finally, capex, they're guiding for around 6 to around 7,000 crores per annum for the next few years. The numbers were in line. The problems in terms of realizations, volumes were solid, but clearly the street got spooked on the back of the realization miss as well as the commentary on pricing as well. Back to you.
Thanks a lot for that, Nigel. But hang in there, stay with us. JSW Steel was the other stock on our radar. It lost about 1% despite a good third quarter performance. What was weighing on the stock? Was it valuations?
Well, that's right. JSW Steel's numbers did beat estimates mildly so, and the margins could improve in quarter four as well. However, the street is a little bit skittish on the valuation front. To run you through the numbers first, the standalone EBITDA per ton will have delivered a good jump up in terms of the sequential number. It came in at more than 8,000 rupees per ton, which compares with less than 4,000 rupees per ton. There was a turnaround in their Bhushan Power and Steel assets that's come into their fold, which moved from a negative EBITDA number to a positive EBITDA number. And the European operations as well did quite well. However, brokerages, they're a little bit skittish. CLSA, well, they have a sell rating with a target price of around 640 rupees. They are working with the EBITDA per ton improving close to around 12,000 rupees in the coming fiscal. However, they say that the capacity expansion is going to make JSW Steel more dependent on exports, which is lower margin business. They also highlight that the stock trades at more than 8 times EV upon EBITDA and around 2.2 times price to book. So valuation-wise, it's expensive. Jefferies, well, they retain they underperform with a target price of around 470 rupees. They say, in fact, the stock is expensive, trading at more than 2 times price to book for a company that's going to give ROE of close to around 10%. They have pulled back their EPS estimates by 11 to around 13%, and also they're nearly around 45 to 50% lower than what the consensus is working with. Finally, ICICI Securities, well, they have this sell rating on the stock with the target price of close to 550 rupees. They say that the company is more vulnerable in comparison to its peers on the steel cycle because of the high leverage that they have in their books. Put all this together, the stock was under some pressure.
Considering the release of money from working capital, plus appreciation of rupee which is happening in this quarter, plus cash accruals that can happen in this quarter, all three together we will be able to reduce our debt.
All right, with that, it's a wrap on this edition of Markets Today. You stay tuned to CNBC TV18. Thank you for watching.